Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. I hope you're all enjoying your weekend. First up, I just wanted to say it's great to see so much lively and thoughtful discussions in the comments. It's an honor to be able to produce these videos for a community like this. So thank you so much everybody. Okay, let's start with the economy, and first up, according to data released by the People's Bank of China this week, overseas investors reduced their holdings in Chinese bonds for a record 5th month in June. The number shows that global funds reduced their holdings of Chinese sovereign securities from 2.38 trillion RMB in May to 2.3 trillion RMB, approximately $340 billion in June. The 5 months represents the longest stretch of outflows since records were made public a decade ago. Bloomberg's Hong Kong team explains that the yields on China's sovereign bonds have fallen below those of treasuries after being above them for most of the past decade. China's 10-year yield rose 8 basis points, or 0.08 of a percentage point in June. The similar maturity US yields jumped 169 basis points in the same period as the Federal Reserve stepped up its pace of rate hikes. The unfavorable yield spread isn't the only factor driving the outflow, however. Quote, "The concerns about slowing economic growth, continued disruption from COVID policies and weak consumption may put further downward pressure on Chinese growth and the attractiveness of Chinese assets. This, along with the potential relative weakness of yuan versus the dollar, will also affect dollar-based investors." End quote. Next up, on Thursday, the Cyberspace Administration of China fined ride-hailing giant Didi Global 8.026 billion RMB, approximately $1.2 billion for 16 legal violations. The internet regulator said Didi had posed serious security risks to the country's key information infrastructure and data security, thus putting national security at risk. The fine is China's largest ever for data breaches, representing around 4% of Didi's 2021 revenue. We remember that the Uber-like Chinese firm has been in the dog box with regulators for well over a year now. The investigation against Didi started in July 2021 after the company filed for a US IPO despite instructions from Chinese regulators not to list overseas due to data security concerns. This reminds us just how willing large companies were back then, before the crackdown, to defy regulators. Indeed, Jack Ma's companies started experiencing their own troubles after he openly criticized the backwardness of regulators, to use his words. The Cyberspace Administration of China, in the Thursday announcement of the fine, said that its year-long cybersecurity probe into Didi has now ended. The question now is whether this marks the end to the worst of the regulatory crackdown for the wider industry as a whole, something that many investors are hoping for. We remember that several national champion technology companies, from Ant Financial to Tencent, have been in the regulatory crosshairs for well over a year now, a painful period which saw massive reductions of market capitalizations. The market appears cautiously optimistic, however. On Monday, the Wall Street Journal broke news that a fine would be imposed this week, and shares in Didi are now trading up 20% over the last 5 days, though still remain down 55% year on year. Hey guys, if you're enjoying the episode, don't forget to hit the like button, and for anyone who wants to go the extra mile, as always, Patreon and Buy Me a Coffee links are in the description below. I really want this channel to be subscriber supported and not rely primarily on corporate sponsorship, so this is a tremendous help. Thank you, as always, everybody, for the ongoing support. Now, while we are on the technology sector, industry commentators believe that Shanghai-based manufacturer Semiconductor Manufacturing International Corp, or SMIC, is now shipping Bitcoin mining semiconductors built using 7-nanometer technology, at least 2 generations ahead of the company's established 14-nanometer technology. This is all despite US sanctions on the sale of equipment to fabricate semiconductors of 10 nanometers or better to Chinese players, which have been in place since 2020. Though SMIC breakthroughs have not been confirmed, multiple financial outlets, domestically and internationally, have cited sources confirming the report, and the market appears to believe them too. Shares in SMIC were up 1.9% in Hong Kong yesterday, Friday, and several key domestic chip gear firms like Advanced Micro Fabrication Equipment Inc. and Shanghai Fudan Microelectronics Group Co. saw jumps of more than 5% in share prices. SMIC's progress, if accurate, represents a challenge to Washington policymakers, as well as the effectiveness of export controls as a tool for slowing PRC efforts at building a competitive semiconductor industry over time. Now, finally, for the economy, we remember back in June, the State Council, China's cabinet, published a plan to raise 300 billion RMB from policy banks to finance infrastructure projects in an attempt to stabilize growth in Q3 and Q4 of this year. This week, 2 of the country's large policy lenders have set up new units to manage the funding of this stimulus push. So the funding is very much underway. According to Yicai, China Development Bank, CDB, China's biggest policy bank, issued 1.3 billion yuan of loans to finance a highway construction project in Shanxi and an airport project in Henan. This was announced yesterday, and the day before, on Thursday, Caixin writes that Agriculture Development Bank, ADB, China's second largest policy bank, announced the establishment of a new fund management company which issued a 500 million RMB loan for a hydropower station project in Chongqing. This is in the southwest of the country, home to the famous Chinese cuisine hot pot. In the following weeks, we should expect more announcements like this, funding large-scale infrastructure projects. Between the Shanghai lockdowns, the international environment, zero-COVID policy, and ongoing housing crisis, which, as we have explored this week, is now bleeding into the real economy, raising fears of financial crisis, Beijing has turned to huge stimulus to stabilize the economy in the second half of this year. Though this is expensive and unhealthy growth, at least it keeps people employed and saves face in a sensitive year. More stimulus could well be on the way too. This week, the Ministry of Finance is said to be considering allowing local governments to sell yet another 1.5 trillion yuan of special bonds in the second half of this year in order to shore up the country's economy. In the next video, we will explore once again the state of local government financing in the country. Now, let's end with the quote of the week. This week, in a discussion paper that has been widely shared among foreign policy elite in Western capitals, the century-old New York-based Council on Foreign Relations argues that China's global image is collapsing. For the quote of the week, we will examine this piece. The Council on Foreign Relations is an American think tank specializing in U.S. foreign policy and international relations. While the think tank is generally considered bipartisan and enjoys diverse philanthropic support, this particular paper was supported by the Charles Koch Foundation. This is the quote. China's image abroad has declined significantly in the past 4 years, a sharp reversal from the relative popularity it enjoyed in Africa, Asia, and Eastern Europe from the 1990s to the late 2010s. There are multiple reasons for China's deteriorating global public image: China's overall rising authoritarianism at home, its cover-up of the initial COVID-19 outbreak, and its brutal repression in Hong Kong and Xinjiang have hurt its perception among many foreign publics. Moreover, the aggressive wolf warrior diplomacy style that has become popular under President Xi Jinping has drawn the ire of smaller countries in East and Southeast Asia, and its attempts to economically coerce countries such as Australia and Lithuania have backfired. In many parts of the world, China has the lowest public perception in decades. The United States and other partners can now more easily work together to create a range of informal coalitions against Beijing to limit China's access to critical technology, impede it at international forums like the United Nations, where Beijing has been making gains, and constrain it with newly formed or closer military relationships, among other measures. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a great weekend, and I'll see you on Monday.